Well, hello to all of you. It's wonderful to have so many of you online tonight. And tonight we're going to talk about the numbers. You know, different people have asked me, what about the numbers? Well, as a company, both Migrate and the Global Wealth Group, we basically want to go through the numbers. And with regards to the Cedars campaign that we're doing, we've run a series of webinars. We ran the webinar with Roger Hamilton 2 weeks ago on the future of business, the future of trends, the Big Bang. If you missed that, I would highly recommend. Last week, we ran the webinar with regards to our technology and where we're going on our technology and how we see a global real estate marketplace actually working. And basically, tonight we're going to be looking at the numbers. And then next week, I'm going to take you on a window into the future in terms of where we see the world going over the next 5 to 10 years, the major trends that are actually colliding, and the opportunity that it presents itself for those that are prepared to build a solution for the future. So before we get into the numbers, I just wanted to share with you a little bit of an update. Also, just with regards to Ken Williams, he's actually on the train coming back from London, and unfortunately the train has got delayed. So it is important. Obviously, he is a very intelligent person. I always tend to joke he's above my pay grade when it comes to understanding the numbers. However, as the CEO, it's my prerogative to understand the numbers as well, and I'm very averse in terms of what our numbers are. So I'm quite happy to share with you, and when he joins, hopefully later, he'll be able to answer any questions if the train gets back to his house. So let's get going. Why is it important in terms of what we're doing? So I always tend to say, it's very important to understand the numbers. It's important to understand what we're doing and how we're doing. But the most fundamental thing is to understand why we're doing it. And really what you're looking at is that middle-class investors around the world don't have access to quality opportunities in a safe and simple way. They generally are limited in-country, wherever they live, whether it's in England and they're worried about Brexit, or South Africa and they're worried about the political future, or China, whatever it is, they're stuck in-country. The barriers to entry are very high to be able to invest in even residential, but let alone commercial or offshore property. And then it's very complex, tax, banking, structures, deal quality, partners, et cetera, et cetera, et cetera. And basically what it means is that 99% of the world's population doesn't get to invest like the top 1%. Now, why is it important that the 99% invest like the top 1%? Well, firstly, 49% of the world's wealth is held in property or real estate around the world. Of that, only 12.9% of the world's population actually has access to that real estate. And what I find quite disgusting is of that 12.9%, in the Western world, less than 1% of people are going to retire wealthy at the age of 65. Now, if you're interested, 94% of people are going to retire broke, and 5% of people are going to retire trapped. That's not exactly a system that is working. We decided to change that. We decided to allow the 99% to be able to invest like the top 1%. We decided to ask ourselves a question: how could we make global real estate investing easy? And with our platform, we've now allowed people to invest in quality opportunities with quality partners from as little as $1,000. And we beta testing $100, and with our new platform that's coming out, we certainly want to go to 100, possibly even 10. So in the past, it was all about hassles, management, maintenance, broken toilets, and that's if you're just local investing. If you're going offshore, it's about offshore structures, tax, compliance, etc., bank accounts, and we've taken that all off the table. Now people can truly participate. Hello, Ken. Now people can truly participate in the best returns, and really just to be able to really look at the global opportunity. In terms of the business model, it's a really simple business model. It's a traditional marketplace, and what you're looking at is that you've got global investors, you and I, from around the world, that want to get access to quality partners. Now, at the moment, we've got quality partners in the USA, UK, and Australia. We are looking to bring on quality partners in South Africa, quite soon, hopefully Portugal, Cyprus as well, in terms of where we're going. And what that basically means is that in any market, you've got quality partners, and they want access to global investors. They also want to join the digital, ecosystem. And so they list on the platform. The global investors can invest with them, and they manage the investments through the platform. In terms of our traction, for anyone that watched the webinar just last week, Can anyone tell me how many countries were we on just last week when I gave this update? I'm not sure if anyone can remember or anyone's been paying attention, or if anyone's been looking at the Cedar campaign. We've been using one number because obviously we've got to stick to one number. But for the purposes of this webinar, I thought it was quite interesting to add the latest update. And Pierre van den Berg, you win the toaster. Well done. You were the first person to answer the question. It was originally 118 countries. It's now 125 countries. So really quite exciting how that number is growing. We've got investors from 59 countries. We've facilitated deals of over 500 million. We've now done over 2,300 transactions. We've had $79 million go through the platform. It's actually higher than that. We're just waiting for one of the big medical deals to close, and that number will jump quite dramatically. And what's really interesting for me is that we've got a higher than 70% reinvestment rate in terms of where we're at. So my suggestion is, as you saw, Ken's face popped on. So hello, Ken. How are you doing? If he is there. And what I'm going to do.
Sorry, I'm late. Came down from London and got caught up on the train. So my apologies.
No problem, mate. So what I'm going to do is I put together a presentation. What I'd like to do is run through that presentation, and then if Ken's got anything he wants to add, Ken, just jump in terms of the process. And obviously, once we get to Q&A, if anyone wants to ask any questions. So let's get into the numbers. I just wanted to give you an overview. I think when one's looking at a digital real estate marketplace, it's really quite exciting in terms of where the future's going. But most people want to understand the numbers and how it's working. So let's start. Take a helicopter up, probably even a spaceship up, and take a really high-level overview. There's three key metrics that drive this business. The first is the number of transactions. The second is the average fees that we earn per transaction. And the third is the average transaction size. In simple terms, we're aiming for $100 million in revenue, which at a 10x multiple, which is conservative, but let's just stay with the conservative line, it would be a valuation of $1 billion. That is our goal. That is what we have been aiming at in terms of where we're at. To achieve that, we need to increase the number of transactions. We need to decrease the average transaction size. In simple terms, the numbers that we are aiming at in an annual period would be 1 million transactions per year, with an average transaction fee size of 5%. So that's monetizing both the demand side and the supply side, with an average transaction size of $2,000. And I'm sure you can do the maths. That equals $100 million, which is the valuation of $1 billion. Now, that's still a long way off in terms of where we're going. But what's very important in life, if you're climbing a mountain, you need to know what the top of the mountain looks like so that you can work backwards as to how you get up that mountain. And these are the three key metrics that really drive our business in terms of where we're going. Now, let's get a little bit more detailed, a little bit more granular. The way we see it, there are effectively 7 parts to this transaction and 7 different parties. You've got the supply side, you've got the third-party verification, you've got the aggregation of the structure, you've got the platform, you've got the demand management, and then you've got the actual demand. Now, in terms of where we look at, we basically see that there's quite an overlap between different players within the market. So I had a meeting today with one of the top banks, and they're effectively their property fund, and they would effectively come up, and they would be sitting over here. Then you've got sponsors like Orvest, who are medical partners. You've got in-country platforms like in America, you've got CrowdStreet, or in England, you've got Property Partner, or in Singapore, you've got Co-Assets, just to give you a few. And then on this side, on the demand side, you've got many different types of platforms. You've got sponsors, you've got affiliates and channel partners. You've even got Migrate. And what we're basically creating is a global platform which allows this to take place. And there's 7 different business models. They range from B2C to B2B to B2P. Now, you've never heard of B2P probably because we made it up. And it stands for business to platform, where there's over 250 platforms around the world, and all of them in country, every single one of them. And what they would love to do is be able to offer their opportunity to international investors. And what we have is international investors who are looking to invest in local opportunities. And so we can provide them with that solution in terms of where we're at. Now, in no particular order, these 7 models have been gone into a huge amount of detail. Now, for the purpose of this webinar, I don't want to go into this level of detail, although I'm happy to if we want to come back to the Q&A section. And you can basically see that for all 7 business models, we're not going to be running all 7 of them at the same time. We are going to be doing it sequentially. But you can see the value proposition to the client, the core requirements, and also the business case. So we've effectively got a B2B offering. We've got a B2B white labeling offering. We've got a B2B channel and affiliate partner offering. We've got a B2C, so that's effectively direct, like through Migrate or some of the campaigns or promotions around women and wealth, etc. We've got the B2P, which is the one I've just spoken about, business to platform, the likes of CrowdStreet or Property Partner around the world. We've got a 6th one, which is B2P white label, so that's where they want to be able to do a white label solution. And that might be a platform that's in Singapore or New Zealand or Canada that wants to plug, because in every single market in the world, property is localized and it has local expertise, even in the tech space. And the opportunity is to allow local trusted partners to plug into a global trusted network in terms of that process. And then finally, the 7th one is internal structuring, setup, and management. And quite often we actually want to shy away from this because it's not very scalable. And under current business processes, it's still fairly manual. So we really want to be able to outsource this, but in some cases we might need to do it, and there's the business case around that as well. Now, what does that all mean? Well, in simple terms, if you look at our proposed structure of the breakdown of our fees, we basically got a demand side structure and we've got a supply side structure. And on the demand side, the intention is for never to let the fees be more than 3%. Now, why 3%? In any marketplace, there's always one specific client. There's one client that makes the entire business work. So if you take Airbnb, and my wife is actually renting out our flat here in Neisner, is that their number one client is the people that own the property. Their belief is if they've got great properties all over the world, people will come. And so they charge a flat fee of 3%. My wife knows that if she rents out the house for $100, she's going to get $97 in her bank account. It's a flat fee. There's no discussion, no debate. So when it comes to property, we want to take away on the demand side, and we believe our number one client is the investors. If there are 1 million investors on the platform and tens of millions, hundreds of millions of dollars transacting on the platform, the best property partners or the best real estate partners will come. It's guaranteed. And so we want to make it really easy on the demand side. And that's why the fee structure would be no more than 3%. There won't be any carries, there won't be any hurdles, or any other complicated language that people don't understand. I tend to talk about my brother. He's a 39-year-old anesthetist, and the only thing he carries is his shopping bags home from Woolworths. And when he goes to a waterfall, it's water that falls off a cliff. Most people do not understand the complicated financial lingo that is used in the financial services industry and or in the property industry. And therefore, on the demand side, it needs to be simple and it needs to be easy. And for us, we basically are like a PayPal where we earn a small transaction fee in the beginning, in the middle, and on the end. And it's based on transactions. Then on the supply side, we've got different levels for the supply side partners. Now, we haven't launched our platinum level yet. We've only launched our gold and our silver. We've already got our first gold partners signed up and already paying us. They've been paying us for 4 months already. And it's a subscription model. And really what our intention here is that we want to build everything around the transactions. And then secondly, on the supply side, we want to basically create annuity income with quality partners. So going into 2019, the intention would take that from one supply paying, subscription partner to hopefully 10 to 15. Now, our overheads at the moment are $150,000 plus minus, almost exactly. So if you take the fact that our current subscription partner is paying us $15,000 a month, we only need 10 subscription partners to fully cover our overheads. And once you've got that, then the demand side is all upside. And that's really what we want to do in terms of breaking down our OPEX and our CAPEX, where our OPEX is being covered by subscriptions and our CAPEX is being driven by growth capital. And that growth capital then allows us to really drive the demand, both through all the different 7 methodologies that I've already explained to you. And that's really where you look at the digital demand. And what that is test, measure, predict, scale. I'm going to talk to you a little bit about that later to give you some emphasis around those numbers. So in simple terms, when one looks at the business model, this is the high-level understanding of the numbers. Now let's look at those 3 key metrics for the business. And let's look at the overall sort of funding. So firstly, I'd like to point out to you that this is the low road projections. And why that's important is that the Cedars campaign is looking to capitalize the business. It's looking, if you take $150,000 and you times it by 12 months, it's $1.8 million. If you give yourself a little bit of headroom, it's effectively $2 million. And the intention of the Cedars campaign is to raise $2 million. Now, you add revenue to that, and you get yourself a 12 to 18 month window in terms of in terms of where you're at as a business. So this is our low road. This is not some big REIT or venture capitalist or institution coming in and writing us a check for $8 million. That would be our middle road, or $20 million. That would be our high road. This is our low road. So people say, well, Scott, come 2019, come 2020, why did the transactions increase tenfold? Well, in simple terms, what's really important here is that as it becomes more and more digital, as we have digital KYC, digital AML, digital processing in terms of people being able to invest, once you get it down to $10 per person per investor, you can significantly increase the number of transactions. And to put that in perspective, Crowdcube, which is a similar organization to Cedars, when we got all their numbers, they were doing 25,000 transactions per quarter. So they are basically doing plus minus 100,000 transactions per year. So when we say we're going to do 50,000 transactions in 2020, it's really not unreasonable in terms of existing models that are in the market. And I know a lot of people say, well, yes, Scott, look at the massive jump from 2019 to 2020. Well, it's because of the digital marketplace and allowing us to effectively allow seamless transactions and to drop that minimum investment. The other thing that's really important is that you can see that the average transaction size dramatically decreases. So we're still sitting above $30,000 on average. For this year, we're closer to $20,000. But if we take the platform over its life cycle, it's over $30,000. So for this year, it's closer to $20,000. That we see coming down next year, somewhere between $10,000 to $15,000. And the intention by 2021 is to get it down to $2,000. Now, again, Cedars and Crowdcube are both sitting at an average of around 1,700 to 1,800 pounds, give or take a bit of transaction and exchange. It's about $2,000. The third thing that's very important is that the business for the last 5 years has relied on effectively doing lumpy commercial deals once a quarter. And we've earned a transaction fee, on doing those deals. What we're doing now is we are dramatically changing the makeup of the business, where there are multiple income streams coming at multiple points in the transaction. So, for many years, we've always had cash flow challenges because we were always waiting for the next big medical deal or whatever to close. That is no longer the case. Every time a dividend is paid, there's a transaction fee. Every time a property closes or a transaction is made, there will be an income stream earned by the platform. Every time, and I've already explained to you the supply partner side and how we get the subscription through on the supply side partner. And then you've got the Wealth University and everything that's involved in that. And I will talk a little bit about that later. And then lastly, you can see sort of in a 5 to 7 year period, which is our focus, is to get our valuation to more than $1 billion. But the way to do that is to get our revenue to more than $100 million. Now, I know that's a long way off, and I know a lot of people, you can see us sitting there in red. Our targeted, revenue for this year was 1.5 million. We've got some deals closing literally even next week. And, I'm pretty confident that we will hit that number. In fact, with the deals actually closing, as long as they close in December, we'll actually overshoot that number. And what's quite important here is that, that then takes into account the share price. and what one can expect in terms of the share price and where the business is going and what we're intending to do. Now, let's be fair. This is a purposeful journey. We want to have an impact on the planet, but we're not a charity. And I haven't invested my whole life in making this thing succeed. You know, at the end of the day, we're here to, number one, look after our customers, because if we look after our customers, I guarantee you we'll have a successful business. And number two is to have an amazing team, because if you've got an amazing team, they will look after your customers. And then the third one is, if you do the top two of those, you will build shareholder value. And if I'm wrong, then why is Amazon a $1 trillion company? And I think Virgin, you know, is another example of that. So if you go to the pitch deck or any of the financial documents, you'll actually see this financial summary. It's a slightly more condensed version of the numbers I just showed you, but it certainly hopefully gives you a better understanding of the numbers and how they fit together. Now, in the bottom left corner over here, you can see the sum of the parts. This is the work that we did in terms of breaking down the sum of the parts. And I wanted to share with you quickly the spreadsheet. Give me 2 seconds. Oh, don't know if you can see that. It's pretty tiny. There were 4 different valuation methods that we used. So we basically got the price to revenue average for 2018, 2019. And you can see there that the value that it gives plus the total number of shares in issue, it gives an average share price. You can see the price to revenue plus the net asset value in terms of the process there. You can see the capex plus the net asset value. And then we also had an external valuation, which was done by a company called Equidum, that is recommended by Cedars. Now, Cedars have, you know, looked under every single rock. It was a, you know, it wasn't an IPO, but it felt like an IPO in terms of us having to verify all the facts and figures. We had to verify absolutely everything. And they went into Equidum, and when they first did the valuation, they actually came out at $34 million. And you know, we decided to pull that back and be more conservative. So we finally agreed on $24 million with Equidum. Now, if you take the sum of the parts, and I'm talking in dollars, it gives you an average valuation of $23 million. And you know, taking the total share price into account, that gives, or the total number of shares, that gives a share price of $1.61. Now, just using the exchange rate of 0.76, they actually worked on 0.77, and it gave us a valuation of on or around 17 million in terms of the business in pound terms. And the last thing that that I just wanted to share on the valuation side was that, you know, for everyone involved in the Cedars campaign, the share price has been offered at $1.50. I think the shares, I think it's $1.15 in pounds. Sorry, not a dollar, £1.15 in pounds. Just taking into account that, and they did fix the exchange rate on a specific day, so it doesn't fluctuate. And then we basically got, you know, from them in terms of the authority, that if you had larger investors, anchor investors, we could then provide them with a discount for roles that they would take within the business in terms of, and they could get effectively sweat equity, etc., which would allow them the discount that has taken place here in terms of that process. So you can see all the different numbers here and the breakdown and the final numbers that we actually used with Cedars just to confirm everything. So sorry, the share price, yes, was £1.15, and pretty much 17 million pounds was the final number. It fluctuated just a little bit in terms of the. Oh, sorry, what are you seeing? Are you not seeing my? Have you not been seeing the spreadsheet?
No, we have been seeing the spreadsheet, Scott. So it's going fine.
Okay. Oh, sorry. I was getting a little bit nervous there that I wasn't on the right screen. Okay, so that's and please, Ken, just jump in and add anything if I'm missing anything that's critical from your side.
Yeah, well, if I may, Scott, you know, I would like to say a couple of things about this, and that is very simply that that, you know, you've got the first valuation is a forward price revenue valuation. So we're at the end of our year. Basically, we're on the numbers that we are to the end of the year. So what we've done is we've taken next year's forecast and this year's forecast, and we've averaged those to give you a forward price revenue number. We've then got a historic price revenue number, so we're using this year's numbers, which is the second valuation, with the NAV, and that's the carry in the properties. That's Allvest has half of that, and we have half, and it is fact that that's 5 million. So we added that together, and then similarly with the capex to NAV. So it's cash received to NAV, and then there's an independent valuation. So very very simply, this is the way fintech companies are valued, and we've had comments around people never seeing a revenue valuation. This is the way it is done in fintech companies. Now, if this was a listed company and we were talking about earnings and we're talking about shares, well, then it's a PE ratio. It's a price earnings ratio. Okay, this is a pre-cash fintech company. This is how you value them. It's commonplace. So this is the way that it's done. And what we've done has been very, very conservative in this circumstance. And just in terms of how the numbers feed, if you wouldn't mind, Scott, if you could just go back to the previous chart, which is
basically spreadsheet.
Yeah, so it's the spreadsheet, which is actually the forecasts for the business.
Sorry.
You do that in the presentation. I'll just make these comments because I'm a wealth partner, like everybody else on this call, and what I'm trying to do is assist. I'm trying to help. What I did is I invested as a wealth partner, and I invested on the possibility of what this business could be, very simply. And if you look down at the bottom, those are fantastical numbers. Okay, so we go from 1.5 up by 2022 to like 48, and of course the percentage increase is massive. So let's be conservative and go to 2021 or 2020, and we've got 9 there as a price. Now what I would do is I'd halve it, and I'd halve it again. It's just a natural thing that I do, and basically kind of you halve 9, it's 4. Okay, half of 9 is 4. Now basically you've done 400% return. Okay, against a price here. So I mean it's 150 at the moment, so it's not quite 400. It's it's 267. My point is that it could be a gem of an investment for us all, and that's the reason. And the only other thing that I'd like to add here is that what Scott demonstrates here is he basically suggests next year that we could go to 3.8 million in revenue. And there are 2 things have cropped up for me in the Cedars campaign. One is that their compliance concerns, like are you guys compliant? And let me answer that first. From a compliance perspective, if you have a look at the business model and where we could potentially go with the business model, well, if we just revenue shared with other platforms who are completely similar and share, are aligned with us in terms of revenue sharing, we could essentially, for no cost, revenue share their revenues with them and their transactions, and we could actually stoke that number fairly significantly in advance of that number if we did that. And so, and a classic example, I've just got back from London, and I met today with an FX provider that could actually be an escrow and a wallet service for us. But they, as an FX provider, would actually like our clientele for the FX. Now they're prepared to revenue share. So there's a 2-way revenue share on that. They can they're regulated. In which case, being regulated, it does not pose any regulation problem because we're working through them. So there's the way to look at this is to say, what can these guys do carefully, completely compliantly on a business-to-business basis before you even look at business to customers? And where could that take us? And that's probably, as I said to you, we could get into the 4 million, in which case, or plus next year, just business to business. Which would against this price is 267% increase against a participation now at 1.5. I hope that helps, Scott.
Perfect. No, thanks very much, Ken. So look, let me see which screen you're looking at. Okay, cool. I think I know where I am now. And what I wanted to share with you actually was just to tie this back to what Ken was talking about. So if I go, picture of my son on the beach 6 years ago. So this is Cedars. We are live on Cedars. Mark actually just asked a question. He said, you know, it looks like Wealth Migrate is full. To really understand this, it's quite important that in simple terms with Cedars, the way that they work is they work in a phased approach. And so there's phase one and then phase two. In phase one, we had £750,000, which you can see there, and we raised it in less than 48 hours, which was really quite phenomenal. We then went we effectively went publicly live on Wednesday. And we're now in phase two, which is in terms of our growth funding, and our next growth hurdle is to reach £1.5 million, which is roughly $2 million. If you look here, you can see the pre-money valuation that I just spoke of. And what I think is quite interesting or absolutely fascinating is that there's 124 investors that have put in, you know, more than £1 million. And that doesn't take into account, there was a consolidated group of people that Ken and I had to upload as one individual. That was another 76 people, I think. So ironically, I didn't even know that. The number is actually pretty much 200 investors on the nose in terms of where we're at. Now, the other thing I wanted to share with you, and I mean, anyone that wants to go in can go in here. You can see the idea, the market, the team, the updates, you know, even the investors, you can see the whole thing. And there's discussions and documents and everything as well. The other thing I wanted to share with you, there's another, property sort of company platform that's on that, on Cedars right now. Now their valuation is £18 million, and what I found absolutely fascinating is that they've done 4.6 million in equity funding and have access to 2 million on underwriting. Our valuation is less than theirs, and yet we've done $79 million in funding. So I mean, call that £50 million. It's 10x what they've done. You know, they talk about their developed own business, critical IP, et cetera, which is fantastic. Again, it's in country, not cross border. And we've got a 5-year track record of doing cross border on 4 different continents. And then the part I found absolutely fascinating is they've got 1,000 users, which that's not 1,000 investors, that's 1,000 users, where we've got 20,000 members. So that's 20x from 125 different countries. Theirs is from one country. And it's just interesting when you look at valuations. We're either seriously undervaluing ourselves, and I remind you of the fact that they said 34 million for us, although we wanted to be conservative and to add value and ensure that we had success, or they are seriously overvaluing themselves. But yes, I find that absolutely fascinating. Ken, I see you popped on. Is there something to say before I move on?
Can I venture a comment? Just 2 comments with regard to what you've just said with regard to Cedars. So firstly, a lot of people have sort of said, so you look overfunded, and it's not a mechanism by which we control. Cedars has done this 700 times now, and what they do is they like you to be fully funded and then overfund. And what we can do is obviously the overfund will just come naturally. But what we could do is we could actually formally say, if it goes exceptionally well, that we'd like to fund to this level. Now, just bear in mind that it doesn't affect the dilution, and it doesn't dilute the stock because of what Scott has affected in terms of the clawback. So even if we went a little higher than that, we're not diluting you. So it's important to understand that, and it's important to understand that Cedars runs the mechanism. So we would like to do a multitude of different things. And we're precluded from doing that, and they FCA regulated, and that's what's quite nice for anyone that participates. So that's the first point. The second point is on this, and it's on this business. And this is a really nice little business, British Pearl, and the guys are all kind of a little bit more like me, sort of from a banking sort of background, and it's a fund. It's basically a fund, and the difference with that is that in a fund you're mandated specifically within a specific area. So not only do they not match on the numbers, with regard to the platform as it stands, but they don't have the ability to provide differentiation, which is what the platform is keenly moving towards doing. So it certainly affects them. And what they have said sort of publicly is they've had a look at our situation, and they've said, you know, the guys aren't necessarily FCA regulated in this country at this point. Now, we aren't. We're applying for FCA regulation. We've made that absolutely clear in the UK, and we're doing it in the UK specifically because we think it's a progressive environment. What's interesting is what they don't realize is we would like them as a client. So in actual fact, they are regulated. That's fantastic. That's exactly what we're talking about, is business to business. What they can do is they could come onto our platform. They could join us if they were compliant in our regime of how we work. We could do British properties through them, through our platform, on a revenue share basis. And this is exactly the business to business model that I'm talking about. Now, for that, there is no requirement at all that we need to be regulated. I mean, they are the regulated party, and they're coming in with their client base. Just a couple of thoughts.
Cool. One other comment that I probably should have made while you were talking about B2B, because Denise just asked around the B2B side, is that this is not something that, you know, we're the first ones to think of. When Amazon built their company, their first sort of 10 major suppliers, they actually brought them in, they did revenue share, and it was basically the way they built Amazon. And what most people don't know is that WeWork is the biggest landlord in London now, and recently just got $1 billion from the Future Fund. And they did exactly the same thing in terms of bringing in developers and property partners. So it's actually Roger Hamilton that's been giving guidance to Ken and myself and the team at large, and really something we want to focus on next year, because, you know, it's something they've just done with Genius U, or maybe not just done, but they're in the process of doing, and it's going to increase the value of their business anywhere in the realm from sort of 30 million to 50 million by doing this. So it's, again, a tried and tested formula that we can copy. I'm going to keep going just to finish off, and then I will make sure we got time for Q&A. I want to answer a quick question around why education. So any of you that have been in this ecosystem for a while, and anyone that knows me for a while, has heard me talk a lot about education. And, you know, you will know about all the webinars that we do, and you know, the events and everything else. But there's a tremendous market in education, and we're basically leaving all that value on the table at the moment. Now, there's two things that are really important. Firstly, when it comes to online education, there's been massive adoption. And secondly, when it comes to online investing, there's been large growth, but not huge adoption, not mass market adoption. And so how do you achieve that? Well, you achieve mass market adoption through online education. So I tend to use the metaphor that Wealth Migrate is the basket, but the Wealth University is the hot air balloon. It's the one that's going to drive it. It's the one that's going to drive the momentum. And what's important from a compliance perspective is that, you know, you've got to be careful what, and Ken's already mentioned this, of what you can do when you're soliciting securities in different countries and different regulation. When it comes to education, you can paint Big Ben in whatever color you like and market and solicit, you know, education products. There's no regulatory framework around education. And so you can build a trust, and then you can provide people with solutions. When one looks at the maturity of engagement, you know, it's gone from sort of publishing to social media to e-commerce, and now it's all getting married together in terms of social commerce. Now, I don't have time tonight to go into blockchain and why that effectively is the foundation underpinning the social commerce environment. But what it does mean is that people want an increase of share of wallets. So what that means is they want an increase of people's digital spend. They want stickier money. Now, if I invest on PayPal or eBay, is it sticky? Yes or no? If I invest in Amazon, is it sticky? Not really. But when I invest in a tangible asset like property, it's very sticky. It stays there. People get, you know, transactions, etc. And then they also get annuity income. And all three of these things are key features that are very important in terms of where the digital economy is going. In terms of our business, you know, we've created different customer journeys for our, you know, beginner investors, our intermediate investors, and our advanced investors. And that's why we got multiple products. And again, tonight, I don't have the time to go into all the detail. But what's important is to understand that we don't have a one-size-fits-all, and that there's different product offerings to take people on their customer journey and to ultimately help them no matter what their level of sophistication is. Now, this is a fairly basic graph, but the way we see a global real estate marketplace, and Richard went into this in quite a lot more detail last week, was that we see 6 different components to a global real estate marketplace. We've got the buy, the sell, the rent, the invest, the service, and the education. 10 years from now, just like Amazon, we tend to be in all 6 of those. Right now, we focused on the investment part. That's where we believe the biggest need was, and also where we could be unique. And now we are really ramping up the Wealth University in terms of the education. And you can see the green is already happening and the orange is already, is on its way. Now, in terms of what we're doing, this is the Wealth University. I'll share with you some of the websites just now. We created the investor test. If you haven't done the investor test, go and do it. It'll give you an investment report, which is based on the I Ching and over 5,000 years worth of knowledge. It takes the fundamentals of investing, wealth, and property, brings it all together. It helps you know where you are. It helps you plan for where you want to get to, and it helps you create a personalized path to wealth in terms of getting there. Then in terms of the micro degrees, this is something that truly, really, really excites me. And why I say this is that Udemy is the biggest online education marketplace in the world. We went live with Udemy about 2 weeks ago, I think. It took us about a month to get qualified. And so our 8 steps to wealth through real estate is now live. And what I find absolutely fascinating, in less than 2 weeks, we've got 1,289 students. They come from 95 different countries. 19% are from the United States, 12% from India. If anyone doubts why I keep saying that India needs to be on our target market, Poland, 7%. Brazil, Paul Niedera was talking to Ken just this morning around why we need to be in countries like Brazil, and then Egypt. And for me, this is absolutely fascinating, because if you want to know how much money we've spent in getting these clients, it's naught. So clients from 95 countries, and this is basically digital onboarding. If you've ever been to an event and seen me do the live 3-hour presentation, that's what this is all about, digitally onboarding. You obviously know about, hopefully you know about the book, the white paper, the different groups, and the weekly wealth insights, and then even the webinars like the one we did with Roger 2 weeks ago. Now, then we go to the paid for version. So we've got a Wealth in a Circle, and this, I don't have time tonight to go into this, but this is an entry-level product. This is where people can come in. Every single month they'll get access to the latest information. There are websites, so you can go and read all about this. And there's the wealth quotient in terms of the test and everything you'll get. In terms of the Wealth in a Circle, there's 5 different things. It's about being part of a global community. It's about learning while doing. It's about coaching and information sharing. It's about compressing time. Your greatest asset is compressing time. So what I mean by that, well, one day there's going to be 20, 50, 100 deals on a platform, and someone needs to condense it and make it easy for you. And then ultimately it's about growing belief. And what we're really looking to do here is digitally onboard people, provide a framework, a digital community where they can really learn and grow. Then we've got the digital, we have renamed this the Digital Real Estate Mastermind. And this is going to be primarily for our property partners and suppliers. It's going to be at the intersection of exponential technologies and blockchain. This is all launching in January 2019. And ultimately, it's going to help them future-proof them. It's all going to be about the customer of the future, social proofing, and everything that they need to know to be digitally relevant in the next 10 years. And then finally, we've got the Global Real Estate Mastermind. This is our premium product, where ultimately a handful of invited people will be working within masterminds with the intention of becoming global citizens. And the beauty of a mastermind is that people hold each other accountable. And so we'll be driving these masterminds. Certainly, I'll be driving the first one, and with time, we'll be doing it regionally with global authorities. We've got some amazing people lined up to be part of this. Richard Dunn is very much driving this process in terms of where we're going. Now, why is this all relevant? Well, what you'll see is that when Ken and I spoke tonight about the numbers, a lot of people say, well, how are you just going to get revenue growth? Or are you just going to do more deals? And the answer is yes, but the revenue growth comes from very different methodologies. So not only are we going to do more deals, or more importantly, I don't like the word deal, we're going to do more transactions, But we're also going to be bringing, and I started with 7 different business models, things like the B2B business model that Ken has spoken about. And completely independently to this, we're going to be bringing all the education revenue streams into the business as well. And that's where, there's some pretty pictures here, but you can see what is the intended outcomes in terms of the revenue. And then if we can achieve that target revenue, what that basically means in terms of the share price. And I mean, this is the pretty pictures for the numbers that we shared earlier before. In terms of just the, how tech companies work, well, most people get to participate once a company IPOs, Facebook or Amazon. Very well, no one probably on this call got invited to invest in Uber or Airbnb up front. And, I bet you wish you did now. Most people don't really want to get in complete startups with no track record, and they're sort of their mate down the road in a garage. And so what we're doing through the Cedars campaign and through our wealth partner concept is allowing people the opportunity to invest at the growth stage within the business. And, I'm not saying we're Amazon, but as an example, if someone had invested pre-IPO in Amazon, $10,000, today it would be worth $12 million. Now, again, we're not Amazon, but it gives you an idea in terms of the value chain and ultimately allowing people further up the value chain. The last thing that I wanted to share with you before I just give you some concluding thoughts is that I was asked about, this is about 2 years old already, that we just keep updating. But including us, so 4 of the biggest platforms out there, Co-Assets, which is listed on the ASX in Australia and pretty much covers Australasia, Property Partner, which is out of the UK, Fundrise, and Realty Mogul that are out of America. All 4 of them got significant funding, and they also all got a valuation. The lowest valuation across all 4 of them was $44 million US dollars. And what was fascinating is that we did a comparative analysis of what were their metrics and what were their numbers at the time of their Series A. So just to look at it in terms of transactions, these guys were 3,467. These guys were 6,200. Yeah, they were 1,000. They were 600 to 1,000. We're already 2,300 plus. If you look at another one, just in terms of target markets, but the one that I really wanted to show you was the equity raised through the platform. So Co-Assets was about $6 million. Property Partner was about $32 million. Fundrise about $40 million. Realty Mogul $45 million. We're sitting at $79 million already. And so the average comparable Series A funding that they received was just short of $14 million. And the total equity raised on average was $34 million. We are double that. And at the time, they got funding of in the region of $14 million and at a valuation of anywhere from $45 to $60 million, generally working on 20 to 25%. And the final thing that I wanted to say was that, people ask us about an exit strategy. And we tend to say there's 4 different exit strategies. The first one is a liquidity event. So if you look at the private companies like Airbnb or SpaceX or Tesla or Uber or any of them, the problem that they've got is that you've got early investors that want liquidity, and you've also got staff members, team members that want liquidity. And unfortunately, your balance sheet can say you're worth $10 million, but if you can't buy beers at the end of the week, and you got a problem. And so what they did is they built in off-market liquidity events, annual liquidity events, and they learned the hard way from what happened at Facebook, because when Facebook IPO'd, more than 50% of the shares actually traded off the IPO. And so there's now best practice that has been put into place by Airbnb, Uber, Tesla, SpaceX, etc. And we copied that with the intention of having an annual liquidity event. It's all very clearly outlined in the shareholders agreement. It's at a fixed price. If people want to participate, they let there's a 3-month notice period. They let the team know. And if we overwhelmed with demand, fantastic. It'll all be taken up. If we're not, and someone puts up 100 shares and they only sell 50, well then that would take place. We're not doing a liquidity event this year because we've been through the restructure, and so the next liquidity event would be this time next year. The second is a strategic sale. So someone like a social media platform or Facebook would ideally want to have the stickability that we could offer their users. A bank or investment firm, like the meeting I had this afternoon, funny enough, they've lost touch with their clients, and would want to be able to, be in contact with their clients. And then a REIT or real estate company, a global company that needs to get access to the technology. And this is happening all the time. The third one is to dual list. Our intention is to look at the London Stock Exchange and the Hong Kong Stock Exchange. This is really Ken's expertise, although for me, 5 to 7 years from now, I believe probably the fourth one is probably going to be more of a reality. And when you think of a listing, what is it? It's hundreds of thousands, if not millions, of investors around the world being able to participate in a company and paying the likes of JP Morgan 12%. Well, tokenizing a business is pretty much the same thing, maybe just without the 12%. And so, I don't know what's going to happen in sort of 5 to 7 years. But both those strategies, 3 and 4, allow us to allow investors at a macro level to be able to participate. Ken, I see your camera's on, which means you obviously want to say something.
Please, Scott, if I may, can I ask a big favor, Scott? Could you pull up the WealthE site? And I just, it's in response to what you've said. So over this period, obviously we're moving our share register, and I've been asked a couple of questions, and I just want to come back to exactly what Scott's talking about here, which is the exit strategy and the liquidity event. And so the first thing to point out, so from this site, is to point out the bottom, right at the bottom of the site. So this has been live for a year. So nothing has changed in terms of our strategy.
At the bottom?
Right at the bottom to the Statue of Liberty.
Yeah.
So the point to make to everybody on the call, so that we're absolutely clear, and I loved Mrs. Schoen's comment, Lynn Schoen's comment, the way she described her interest in the investment. WhatsApp never made a bean, not one, in revenue. Never ever in revenue, let alone cash flow. It sold for $19 billion to Facebook. So there's the first comparative with regard to technology. To put us in the same context as those sorts of people, absolutely, you could poo-poo my suggestion to even be named anywhere close to them. What's very interesting here is now our strategy with regard to how we fund and our liquidity events. So if you take Cedars being nice and successful for us, well, then the case would come that within about 6 months to 8 months, you'd want to have a look at how you fund your next progression. And to do that, on the basis of realizing the metrics that Scott is talking about, there are a number of ways that you can fund. You can go back to Cedars, which is a crowdfund route that we've taken. It's an equity raise. You could go for mezzanine debt. So that's not senior debt, it's mezzanine debt. You pay a little bit more for the mezzanine debt, and they will come in. So for example, we could take down 10 million in mezzanine debt finance. So it's a loan at a percentage. Now we could change that as well and say that we can make that convertible. So it's a loan on a 3-year view at 8 to 12% interest. If we're growing at the multiples that we've told you about on this call, it makes every bit of sense that you would go for it as a mezz debt lender. Then in 3 years' time, either we pay back or you convert your debt into stock at a pre-agreed value, an option. So you've got a convertible option as a mezz debt lender. What would that do to everybody on this call from a dilution perspective? Zero. It's non-dilutive. It's debt. Now, the other point that I strongly want to talk to is Scott's launch of the coin and what actually happened over that period of time and where the tokenomics is moving internationally. And that is that there is no way without this type of CEO that this business could have launched a coin. You need a workaholic to do everything else that he's doing to actually get the coin off. If you have a look at the globe at the beginning of this year in Q1 with regard to coins, the regulation changed against coins completely. So what did we achieve? We achieved 3 million into the business. What did Scott want? Well, he wanted 30 million. That would have been good. People were getting 30 million on business plans, not executed strategies like this where you've got people in 125 countries. Now, what's important about this is that at that time, he couldn't launch a security token. He had to launch a utility token. And legislation has obviously changed towards security tokens. So looking at someone like myself and saying, well, what are you going to do with regard to your funding plans for next year? What we could look to do, depending on the tokenomics of the globe at that point in time, is we could convert to a security token. If we convert to a security token, you can issue it again as a security token, asset-backed by property, which is what Scott always wanted to do. So you've got Bitcoin, and you're worried about a Bitcoin wobble. How about having a coin that is asset-backed by property? And the prospect of this becomes very, very meaningful for us. If we raise that way, it's like mezzanine debt. Nobody on this call is diluted. It is not an equity capital raise at all. So we've then got the 30 million that we can use to push ourselves forward from a digital perspective, from a technological perspective, and so on, to actually move us into higher echelons of business to business, business to platform, and then business to customer ultimately. Finally, with regard to liquidity events, one thing that Scott has been hugely successful at doing, and testament is the amount of people on the call, is to build a wealth partner community. Now, he has insisted to me that through Cedars, that someone who invests at £10 isn't the same as someone who invests as a wealth partner at £10,000. But there's a categorization. But he unequivocally wants the community to be involved and to grow. Now, as that community grows, people
just to jump in while you're talking about, I'm not gonna talk, but I'm just showing people the different levels. So where you talk about,
So very clearly, what this means is that over time, why would you do away with the Wealth Partner Program? I mean, you actually want the community, because that will drive the platform. And as testament, if I'm allowed to use their names, people like Kim Van Niekerk, people like Ingrid Ovenstone, who've helped us over time. Very, very commercial people who have stoked their own communities. Now, the point with the liquidity event is, we could put up a table and say, did you want to sell your stock? And we say that it's at that price. But there's going to be wealth partners, both sitting on the call, who actually want more stock, and they're going to be new wealth partners that want to come in at a price that might be suitable to you. So if we go from $1.50 to $4 at the end of next year, and you decide to sell, and there are no takers, so you say, okay, I'd like to sell at $3.50. Well, we could orchestrate that for you. But that's it's between you and a new partner coming on. So
again, just to jump in, that's very clearly dealt with in the shareholders agreement with a specific formula. And again, it's not my opinion or even your opinion. It's best practice from SpaceX, Uber, Airbnb, etc.
It's just very important that people understand that we are not a stock market, so we're not listed, we're not public, we're a private company, and and you're investing in a private company, and generally over the preceding years, and you invested in private companies, that was it. You locked it away, and that was it. What we are trying to do again is proactively provide liquidity. That's it from me, Scott.
Perfect. Okay. Look, there are a bunch of questions, so thanks very much for that question. I just want to quickly jump through a couple of slides, and then I want to get into the Q&A for people in terms of where we are. So just to run through a couple of highlights from the previous 2 weeks webinars. Roger Hamilton spent a huge amount of time talking about where the next unicorns are going to come from. A unicorn is a $1 billion company. Specifically, there was a lot of talk around Asia. There was a lot of talk of offline, so they call it O2O, offline to online, and also online to offline. And it's really, when you think about it, it's the exact space that we're actually in. You've got real estate property that's a physical asset, and you've got this online environment, and that's what O2O means in terms of the long-term, future trends and everything else. I'm not going to, go into that. If you want, reach out to us or type in there, Roger, and we can send you the link. In terms of the Big Bang, what's fascinating is that there's a massive metaphor here that in 1965 the average stock was held for 6 years, and today it's lost just 22 seconds. And the reason being is that now it's all global, and companies like E-Trade came along, and they basically made investing in the stock market easy for everybody. There's plenty of companies out there that are billion-dollar companies like E-Trade. E-Trade is a $13 billion company. It's been going since 1982. And in simple terms, it made investing easy and it made it global. When you look at property, I find it quite fascinating, but even today in 2018, the average property in America is owned for 8.7 years. And the question I ask is, do you think it's going to take 40 years for a digital platform to digitize the property space? And, when you look at the Big Bang, you can see the wealth creation that took place in terms of that. When you look at the competitors, and I've spoken about many of them, they are all in country. We are the only one that sat back and said we need a global solution. And again, we don't see them as competitors because we want to plug them into a trusted global real estate marketplace. In terms of the distribution, this slide is still showing 118, so I need to update this because it's now, I don't know, Ken, if you even know this, I found out today it's 125 countries, which is quite exciting. And, for me also in terms of the property partners, what's really interesting is you've got a lot of diversity. So, we helped investors, 228 investors from 20 different countries invest in a Big Five game reserve that has done really well and continues to do really well. We've helped people invest in medical deals in America and sort of everything in between, in terms of residential, etc. And so, the intention is to build up that diversity, but always focus on quality partners, and selection in different markets. And if you're on the webinar 2 weeks ago, we did one on the golden visas, so EB5 in America, Portugal, Cyprus, Australia, and New Zealand. And again, we intend to bring all those partners because there are people that have those needs. In terms of our team, we've got a fairly balanced team between tech and the commercial components of property, and also particularly on the tech side, we've got the board, we've got a team which is across 5 different continents, and we've also got a number of blockchain advisors, and all the detail is on the Cedars platform if you want to go and look at it. I've been through the track record. I don't think I need to repeat it, but I do think sometimes as wealth partners we want to beat ourselves up and we want to say how much we haven't achieved, and and there's been challenges, and quite frankly I agree with you. However, one of my greatest weaknesses is always focusing on the future and always want to take it over the world and achieve, get to the top of Everest. And sometimes you need to just sit back and enjoy where you are. And there's not a platform out there at the moment that has members in 125 countries or has the numbers that we've got in multiple countries, in multiple deals, winning a bunch of awards and, et cetera, et cetera. And I just sometimes think that we all just need to sometimes take a step back and reflect upon that. And if I'm wrong, then what's interesting to me is why 124 people. Now remember that Ken and I have put in another 76 people, and just for while we've been on this webinar, another 2 people have invested. And what's quite interesting, they've invested over £10,000. So we're now over 200 people, have participated. And the greatest story when it comes to valuations is willing buyer, willing seller. But clearly we have a story that resonates with people. And so if people are interested, we do have Seedrs. You can go to Cedars /Wealth Migrate. You can get all the information. They are an FCA regulated platform. They allow anyone in England or Europe to invest, and 32 other countries around the world. So Singapore, Hong Kong, the United Arab Emirates, Chile, New Zealand. There's plenty of countries. There's some really bizarre ones as well, like Russia. What they don't allow, unfortunately, is South Africa because of exchange control, or Australia or America. And so in that circumstance, if someone lives in those countries, we have to have an offline conversation with them and make sure that they can qualify in terms of that process. And really, for me, in conclusion, is that 2 things. One is I tend to joke with people. However, I really feel quite strongly about this, that there's a gap in the market to create the Amazon of global real estate. When you consider what Amazon has done to retail, there's absolutely no reason why we can't create the Amazon of global real estate. And the last part for me is that, we talk about our participation premium. And I tend to remind people why people become wealth partners. The first reason is the profitability. We're all here to make money, and we've spoken about increasing the share price, and that's certainly our intention. And I doubt few people could challenge me on my work ethic. Certainly not Ken or any of our team, quite frankly. We do, 20, pretty much 7 days a week. We're out there consistently looking at how we can grow the value of this business and add more value to more people. The second thing is that we want to build a global, like-minded community. We've already got 140 wealth partners around the world. And what we find fascinating is that there's different ecosystems upon which people can work. So this is the wealth collaborative economy we created back in 2015. And you've got the real estate part, you've got the technology part, you've got the investors part, both online and offline. You've got the vision and mission, which is where the Wealth University and Wealth Movement come in. You've got exponential, which I don't have time tonight to talk about. And then you've got all the usual business of finance, legal, etc. And something we really want to start driving forward in terms of our partner and our communities is really driving this so that people can gain more value in terms of becoming global citizens and really thriving in areas that they love. If you take due diligence as an example, everyone said Wikipedia would never work. It's now far more accurate than Encyclopedia Britannica. There's 19 million accredited people around the world that add value to Wikipedia. And I know you all think I'm absolutely stark staring mad, but I guarantee you there'll be a future where there's community due diligence in the same way as Wikipedia, and it'll be more accurate than a homegrown investment committee. I know you think I'm mad. I'm happy to take a bet on where we're at in the next 10 years. And then the third part is all around the purpose. And through the wealth movement, and I didn't actually put a slide in there for the wealth movement, but this is something that we created many years ago. Hilda, who's one of our largest investors and anchor investors, also a board member, actually wrote this poem about the wealth movement. And our whole intention is to ultimately empower 1 billion people. And we believe that by allowing the 99% to invest like the top 1%, we can truly have an impact in terms of solving the wealth gap. There's a poem here written by Hilda in terms of our manifesto, where imagine a world where most people are literate, where the world's education is par for the course, a world where women are treated as equals, a world where all people have access to investment opportunities. Imagine a world where 6 billion people on the planet who currently live in poverty can live a better life. Even if we can only help 1 billion in the next 5 years, imagine that world. We want to do it. And there's 3 major areas. There's entrepreneurship for children, there's empowering women with access to financial education, and then there's providing the opportunity for the 99% to be able to invest like the top 1%. And so that's all from my side. I've already shared this with you because Ken actually brought it up a little bit earlier. There's 6 different levels to being a wealth partner. If you're an investor, if you're a property or property developer or real estate partner, there is actually a different matrix that we can send you. And if you are a property partner, you can just type in there property partner. And you can see all the different benefits. But I tend to say to people, being a wealth partner is not for everybody. And for most wealth partners, they actually resonate with all 3 of the components that I've just mentioned in terms of where we're at. And for those of you that have supported us in the Cedars campaign and the whole 10x campaign, we are deeply, deeply grateful. Thank you very much. This campaign is really going well, and it's really driven by our community. And it's certainly not Ken or myself or anyone else that takes the credit, because this is a community engagement in terms of what has been achieved. Now, I am conscious of the time. We're pretty much on the hour, a little bit over the hour, sorry. But there are a bunch of questions here, and so my intention is to answer these questions and to run through each and every one of them. If people do need to drop off, fair enough. Just before you go, though, and while I'm answering the first couple of questions, I've got 3 questions for you in a poll, and I'm always just fascinated in terms of what people think based on what they've heard. So let's run through this now quickly and see. Okay, so Mark asked about, I see Seedrs already subscribed. Again, if anyone didn't hear, we set the first phase funding goal at £750,000. We achieved that in 48 hours. We've now set the second phase funding goal at £1.5 million, and we're well on our way to achieving that. And and our stretch target is no more than £2 million in terms of where we're at. Is there an option to do revenue share? I think Denise, we explained that in detail. How much is still available? So I did answer that for Mark. Again, I'm sort of converting from dollars back to pounds, but we're looking at about $700,000. Considering the campaign has only been live for 5 days, it's quite phenomenal how quickly it's actually been taken in terms of the process. Denise asked, why are they valued more? Denise, it's really interesting when you work with Cedars and Equidum and others. They do take into account, obviously, what you think as well. And Ken and I specifically wanted to be conservative, in terms of what we were doing. And I've already told you that they basically mentioned to us $34 million US, and we actually pulled them back to 24 million. So there's others that are more aggressive. We wanted to make sure that we succeeded at the Cedars. Peter's asked about the valuation from our auditors. So Peter's an interesting one. I've been through this process with our auditors, PKF, previously. The average auditor has no idea, zero idea about how to value a fintech company. And so what's really important is that we work with people that do have the expertise. Cedars they've done this over 700 times. They raised over 450 million pounds, which is far more than any venture capital or whatever in England. They are FCA regulated. They use a company called Equidum. And why fish in a desert when there's no fish there? We could go to our auditors, but right now you really need Ken, myself, the team focusing on making Cedars a success. And we could go and sit with the auditors, but we spent 4 months with Cedars getting everything set up. I actually met with Cedars, with Ken, back in, I think it was July, Ken. It was my London trip in July. And the whole of August, September, October, we pretty much launched now at the end of November. So call it even, it's basically 4 months, going through the entire process. And, I can't explain to you the level of detail that they made us go into. Peter's asked how much cash is in the bank. So basically from our side, Peter, in terms of the business, we're a growing startup technology company that is arguably always cash strapped. It never has enough money to do what it needs to do. To repeat to everyone, our overheads are 150,000, which is what's called our burn rate. And our intention with the Cedars launch was to raise at least $2 million, which outside of revenue gives us at least 12 months runway. With revenue, it obviously gives us longer than 12 months runway in terms of where we're at in terms of that process. Why don't we align our expenses with our fee income? So, Peter, that we could do that, and to some extent, that's the biggest mistake I've allowed to happen under my watch in the last 4 years. Because although we didn't align our expenses to our income, what we did is we allocated far too many resources to the property side of the business, which is why we did the restructure. 12 months ago, or 12 to 14 months ago, we had 12 people that were in due diligence, finance, or compliance, and we only had 1.5 in tech. If we want to become a scalable digital company, we have to invest in the tech side. And like any other tech company, it takes investment on the front end to get that momentum. However, saying that, our intention next year and the use of funds are very clearly outlined in the Cedars document. As Ken, I think, alluded to earlier, we talk about it all the time, so I can't remember if it was on this call. We've invested a lot in the tech. We will keep investing in the tech, but 2019 is very much around the commercialization as well, and really driving those revenues. When will the company conservatively be break even? So that's an interesting one, Peter, because based on the numbers I've just given you, if you keep the overhead expenses at 150 and you bring on 10 supply partners, you can actually get to break even, even within 2019. And there are strategies around it. I will tell you that for me personally, I've always liked the Amazon model where we can aggressively, fund the company and aggressively grow. However, I do foresee turbulent times over the next couple of years, and I do think it's quite important that we do focus on that sustainability. I don't know, Ken, if you've got any comment to that, but I know you feel quite strongly about that as well.
I think, I think my comment there, Scott, would be to say this is, I personally, in terms of talking about the numbers, and I want to make it clear again, I'm a wealth partner and I'm helping here. It is a fintech company, and that comes with risk. But what we did was, this year the strategy was to get into technology, and that's where Gavin Rousseau came on board. And I like to call these guys best practice as opposed to best in the world, or best in his environment. He's instituted best practice, so that's what he's done for the business this year. Next year, for me personally, and we've discussed this at the board, and it's completely agreed. It's all about revenue and the commercialization. Now, just to verify what Scott said, if we take this through to a number of platforms very, very quickly, we can actually get ourselves to break even. And for me, to quote 3.8 as a target to hit that, we must exceed. And if we exceed it by simple maths, your stock price is going to be 4. Outside of the fact that there may be other clawbacks to affect in terms of the stock that we have available already, we can cancel shares and so on. So I'm in agreement with you, Scott. There are a number of ways to skin the cat, and that's changed with the spin-off of Orbvest, because this allows Scott and the team to pursue alternative revenue streams, so we can climb into a whole lot of alternative revenue streams.
Cool. I'm gonna shoot through these questions as quick as I can. Just conscious of people's time. Denise asked, why did we not have the FCA before we started the campaign? So Denise, it takes the best part of 6 months. We also had to have people based in the UK, so we've been lining up some non-executive directors in the UK. It's quite a lengthy process. We've basically been working with a team of people that are going to help us with the FCA application since July or August. It's been a very lengthy process. So and plenty of companies are on Seedrs. In fact, the majority are on Seedrs without FCA. So we decided from a timing perspective that we wanted to have it done before the end of the year. Okay, so just with regards to Sable, and before we get oversubscribed, so yeah, look, I think Mark, in terms of that conversation, we can't make promises based on the demand. I mean, I showed you tonight live that 2 more people invested and went up by sort of £10,000 while we were on this call. So we never quite know in terms of that, how long that process. There's a hard cap of 2 million in terms of that process. So we don't rush people. People can make their own decisions. But there's a hard cap in terms of our process. I think we've been through that one. Have you positioned Migrate as a sticky offering to get more buy-in? So Denise, I think, as a question, if I understand your question, the metaphor I like to give is that at the age of 12, 13 or 14, I can't remember exactly, Standard Bank gave me my first Order Plus card. Today I'm 41 and I'm with Standard Bank Private Banking. And, arguably I should move to another bank and whatever, but quite frankly, it's too much hassle. I've got all my bank accounts and, et cetera, et cetera. And our belief is that once people are on a platform, it's going to be very sticky to be able to move from one platform to another, and particularly once they got their global investments on the platform. And therefore, the more that we can drop the barrier to entry, the more that we can make the minimum investment $100, $10, and hopefully one day $1, the more people will be able to participate and ultimately get into the system. And just like banking, the intention will be to have a sticky product. So I don't know if that answers you. Okay, we got all these cool value adds like Wealth, Migrate, etc. But is this helping us get funding? I don't know if it's helping us get funding, Denise, but it's certainly driving revenue and part of our revenue plans for 2019. So there's going to be a big focus on that, and it will help grow our demand. And with that, it will help grow our transactions, which will ultimately drive the fundamentals of the business, which is critically important. Boom, boom. Can you get the recording? Yes. Do you know why people are actually participating in the Cedars round? Is there some sort of survey asking why they invested, so to follow up and offer them a further solution, the value adds? We don't at the moment, and Cedars have been interesting to deal with. We got the first list of investors yesterday, and they won't give us their contact details because of GDRP. I think I got it right, but anyway, that legislation around communicating. So that's going to be quite an interesting one. How do we communicate with our shareholders if they won't give us the details? So yeah, we don't quite have that level of detail yet. When is version live? So the more deals on the site, because people look at Cedars and then go to the Migrate platform. So if you look, we've on the platform, we have actually loaded a lot of deals up. I think there's about 12 deals at the moment. In terms of version 5, the new look and the new feel is actually looking to go live now on the 30th of November, which I think is Friday. And as we've said before, that won't involve the transactional banking system, which we're still working on. And we also found out yesterday that the banking solution that we're looking to is also going to be tied to our FCA application, which might cause a delay, and we'll then have to use the current more clunky solution for a little bit longer. And we just, from a tech perspective, we're going to have the new look, but the payment gateway might still be a little bit clunky for a while. You say not everyone wants to get involved in a startup, but your competitors, yeah. So you say everyone wants to get involved in a startup at entry level, but competitors on Cedars are exactly that, with a better valuation of Migrate, and Migrate has a better track record. Exactly. That's why I pointed it out to everyone. And many could argue that our valuation could be a lot higher. Equally, people on this call, would argue that it should be a lot lower. We tried to go with a conservative valuation to ensure that we, A, added value to the company, B, as Ken said, we clawed back shares, so we weren't diluting the current shareholders, and C, we capitalized the company to really be able to allow it to grow next year after what has been a disruptive and painful restructure, but a very necessary restructure. Does everyone know that Cedars campaign is there to create funds to cover expenses for next year, and that we have very little income for investments at present? Hence my question. Yeah, well, I've been, in terms of the process and the revenue projections and all the different revenue streams that we're looking to achieve next year. I want to do an investment via Cedars, but it's not available to South Africa. Andre, hopefully I answered that for you. If you want to speak to myself or Ken directly, we can chat to you offline and see if you qualify to be able to do that. Yeah, so for us, a member is someone who's qualified on the platform and been through the KYC, and we sort of know who they are. So it's not just a user, if you want to call it that. I'm an Irish citizen, Andre, and have funds in Ireland. Well, that's great. Then that's Europe. Sign up in Ireland, and you can easily participate. Anywhere in Europe can participate. Yeah. So Mark, as I answered already, people in South Africa we can help offline. Although if I think I know you well enough, you're from Germany, so you could do the same thing. You have lots of questions about due diligence during your pitch at Cedars, and you said that you don't vet the properties but the partners. Yeah, so it's interesting. All I said is I didn't say we don't vet the properties. I said what we do is we specifically focus on the partners. So our GID system, our global investment due diligence system, there are plenty of very qualified partners. As an example, last week I was in London with Ken. We met two very good partners in the UK. They've got stellar track records, both in commercial and in, one in commercial, one in residential. The one is actually FCA regulated, et cetera, et cetera, et cetera. And so what you do is you find the quality partners like them that want to get access to global investors, that want to, join the digital economy, and we provide them with a solution. And there are plenty of them. And we don't have to mess around with the rats and mice based on their track record. And I would agree, with the comment here that there have been some poor partners that have come on the platform. And Trying to choose my words carefully here. It's why the system has to change. It's why using an old power methodology of top-down control and a couple of individuals based in one geography trying to make decisions about investments in other geographies around the world might have worked in the 20th century, but it's not where the future is going. And we need to build scalable solutions that are trustworthy, transparent, simple, and safe. And we have every intention of doing that. So please send me all the options to be a partner so I can canvas. Okay, so I'll send that through to you. Let's make a note here, Denise. We've got both the website that I've showed you, and we've also got a PDF, so whatever's easiest for people. Is the hard cap $2 million or £2 million? Francis, the hard cap is £2 million. At the moment, we've got a cap of £1.5 million. But we've got a hard cap, as in we can go no higher than £2 million. And then is the hard cap just for Cedars investors or offline investors? It's for offline investors as well. So we did offer a discount with regards to the shares, and there's only a certain number of shares that have clawed back, etc. And so there's a hard cap so that we can add significant value to the company without diluting the current shareholders. And so whether it's online or offline, it doesn't matter. There's a hard cap. There's only a specific number of shares available. And Ken, oh, they keep coming. Okay, Andre asked about the partner requirements as well. Can I also have the PDF? Dimitri's asked. That's fine. I'll tell you what I'm going to do. Let me put I don't know if I can do this quickly. I think I can. For those of you online, if you stay online for 2 minutes, I will actually put the PDFs into the, you'll see it come up as a little handout. This is me trying to be a little bit clever. But and I think that is all the questions. So I don't know if you can actually see me playing around with my folder trying to upload it here. Let me just check here quickly. So this is the investor one-pager. So I'm going to upload that for you. And then I'm going to upload what we call the wealth partner matrix. I'm not going to upload the property partner matrix because for me, people can reach out to me individually if you want me to help with that. Okay, there we are. So I've got both those documents they're in the handouts. You can actually download them. If you're watching the recording, reach out to myself or Ken. You should have our details, WhatsApp or email, and we would love to be able to help. And even in terms of below, I don't know, below this video, I'll try and figure it out. How much has been invested so far for Cedars and offline combined? The Cedars website shows only Cedars. No, Francis. So what we do is we keep it combined. There is quite a lot else coming in. I mean, there's money I know about myself that I haven't even told Ken about because it happened 15 minutes before the webinar. But it is fairly. We try to keep Cedars fairly accurate in terms of that updated amount. It's the place we're trying to keep the source of truth, if that makes sense. And I'm trying to sound clever and use Ken's language in terms of that process. Ken, I'm not sure if there's anything else from you. That's all the questions here, and I see we're on the 90 minutes. If there's anything else that you want to finish off with?
No, just to say thank you to everyone for participating. I mean, the one thing that I might just comment about is the vetting of partners, and just point out what Cedars has done with us. This is quite interesting, and what Amazon does. So I always use the example of an umbrella. If it rains here in England and you want an umbrella, you go onto Amazon, and it gives you 9 umbrella companies. If you click on one of those umbrellas to the right-hand side, you get the company, you get its credit rating, you get its stars, and you get its social proofing. And basically, if your umbrella arrives and it doesn't have a handle, obviously you go directly back to the company, and then Amazon likewise goes to the company. So the company has to qualify. Yeah, and good example is this here. So just to obviously the experts in an economy in property are the guys that you want to be dealing with. You don't want to be dealing with our expectation of who those experts are. You want to be dealing with the experts themselves, and those experts will become apparent very quickly with us. So just wanted to point that out.
Well, I mean, I mean, Ken, thanks for bringing it up, and I want to reiterate it. I mean, if you look here, I just went on Alibaba and I just chose the first thing I could find, and you can see there's different supply types. They've got trade assurance, which ensures shipping. They've got gold supplier and pre-qualified suppliers. They've got assessed suppliers, so third-party inspection. So, you know, we see a future where someone like KPMG or whatever can go and do it in. They've been on the platform for six years. They're a gold supplier. You know, got trade insurance. They've had 4,000 visits, 300 plus inquiries, 81% response rate. You can see all the different products they've got. But what's really fascinating is normally you can go in and actually look at the supplier. And so you'll see here that I'm going, and I'm literally doing this live. I haven't double checked what I'm about to show you, but you can see all the information, verified, etc., all the different, you know, all about the company, their certification, product certification, trade certificates, etc. Now, this is obviously relevant to someone who's buying a garment, okay? But I see no reason why there can't be the exact same social proofing around accuracy to results. You said you're going to pay an 8% return. Did you get it? Yes or no? You know, accuracy to communication, accuracy to timing. You know, and many of the partners where we've struggled with, and I've been in this game nearly 20 years now, you know, will be found out quite quickly in terms of their social proofing. And they're either going to have to sharpen their pencil or they're going to go out of business. It's that simple. And, you know, I know a lot of you, you know, don't necessarily sort of agree necessarily with where this is going. But I basically guarantee you that whether it's us or someone else, this is the way that people will invest in the future, because they'll go and they'll look at all the social proofing rankings. And then based on those social proofing rankings, they'll go and make decisions. And that's what we call smart investing, because you then use big data and artificial intelligence and blockchain and, you know, exponential technologies, and you bring it all together and you help people create their own personal investments. And to use, you know, to finish off with Ken's umbrella example, smart investing will help you find the right umbrella in simple terms, you know, in terms of where we're going.
Scotty, so one further thing, you know, which is my second point, just to add here, is that what Scott has cleverly done, and, you know, I say Scott, the team, anchor investors that have come in. So these are people that are putting in, you know, significant investments. One of the things that we've wanted to do is actually, because we've spoken to some very sophisticated individuals in the space, and, you know, if you look at anyone on the call, wouldn't it be interesting if you just consider how you make your money on a daily basis, whatever your service is that you provide? Wouldn't it be interesting is the process that you have to provide that service on a daily basis? Wouldn't it be interesting if you were paid for that as well? So there was another revenue, because the stuff that you've forgotten, we haven't learned about what you do. And so what you have is you have the possibility of anchor investors that are perfectly aligned with our business. They want to make a difference. You know, we want to bridge the wealth gap. These are individuals that might be in risk. You know, they might be on the wealth management side and want to scale. They might be lawyers. They may be, you know, accountants, whatever. Those individuals can come into our masterminds. They can come into our inner circle as advisors, and actually stoke the revenue that we were talking about in the alternative revenue streams. So you can see how, you know, you can go exponential outside of your core offering, and that's where it starts to become really exciting.
Yeah. So you can see Ken and I get passionate about this. You know, this actually just reminding people of the Wealth Partner presentation that we did on the 10th of October, where we just went through all the different, I mean, there's best practice that's out there. I mean, we really don't have to be rocket scientists to figure this out. And, you know, like I said, you can, you know, have years in business, projects to date, etc. Now, someone said our partner is willing to be transparent. Well, in simple terms, it's not an option. If you want to be on Amazon or eBay or Alibaba or whatever, you have to be transparent. Transparency is the future. And if they don't want to be transparent, they won't be part of the future. It's that simple. Now, whether they want to work with us in the next couple of years or not, you know, that'll be a sticking point. Although we haven't had a problem getting access to good quality partners to date. But you know, it's interesting because there will be partners that will say, oh, I don't want to be transparent and this and that. but it's where the future's going, and they're either going to join the future or they're going to, you know, join the Volkswagens. It'll really be their choice, you know, which side of the fence they want to go to. So, you know, so I don't think there's any other questions, and I do think it's late. We do have a webinar next week, same time, where I'll be running through the future. So, you know, the last 2 weeks we've been running sort of, you know, where we were at in terms of the present. We looked at the numbers tonight, and next week we're really going to look at the big picture vision of where we're going. And you know, yeah, come along. If you've got any questions, ask them on the WhatsApp groups, or you know, come next week and ask me anything. Ken, I deeply appreciate, you know, I'm not even sure if you said hello to your wife and family. You literally got straight off the train, so I really appreciate, you know, the train being late and you coming online to support and share tonight. You know, thank you for everything you're doing. And to all the wealth partners that are online, you know, thank you very much for your support. I have said it already tonight, but I deeply appreciate, you know, I believe the greatest asset we have in this company is our wealth partners, and really what we're trying to do with Cedars is just grow that further. So thank you for everyone's time. Really, really appreciate it.
Thank you. Thanks very much.
Good night.